94%. That's the percentage of day traders who quit within 2 years, not because they got bored, because they ran out of money. A study from the University of California, Berkeley tracked over 66,000 retail trading accounts over a 7-year period. The conclusion was brutally simple. The more frequently people traded, the worse their returns were. Not slightly worse. Significantly, measurably, mathematically worse. And yet, right now, millions of people are staring at charts, buying courses, watching candlestick patterns, convinced that this is how wealth gets built. So today, I'm going to do something nobody in the trading world actually wants you to see. I'm going to put all 3 strategies, day trading, swing trading, and index investing, on the same table. Run the real numbers on each one, and let the math do the talking. No opinions. No guru takes. Just data. If you've ever wondered whether active trading is actually worth your time and money, or whether you've been sold a very expensive fantasy, hit subscribe right now. Because this channel exists for one reason: to show you how money actually works, not how the financial entertainment industry wants you to think it works. Let's set the stage. There are 3 ways most retail investors approach the market. The first is day trading, buying and selling within the same trading day, holding nothing overnight, chasing momentum, volume, and price action in windows as short as seconds or minutes. The second is swing trading, holding positions for anywhere from 2 days to several weeks, trying to capture larger price moves based on technical patterns and market trends. The third is index investing, buying a diversified basket of stocks like the S&P 500, holding it for years or decades, doing almost nothing. Now here's the thing the trading industry never puts in its advertisements. These 3 strategies are not equal alternatives. They are not 3 lanes on the same highway. They produce fundamentally different outcomes for your money, for your time, and for your stress levels. And the differences aren't subtle. They are, in some cases, life-altering. Let's start with the one everyone talks about first. Day trading. The math nobody shows you. Day trading is the most marketed strategy in retail finance. YouTube ads, Instagram influencers, Discord servers, all selling you the same dream. Work from your laptop, make your own hours, print money while everyone else sits in an office. Let's look at what the actual research shows. The Berkeley study I mentioned, published in the Journal of Finance, tracked 66,465 households with brokerage accounts from 1991 to 1996. The households that traded most actively earned an average annual return of 11.4%. Sounds decent, right? Except the market returned 17.9% in the same period. Those active traders underperformed by 6.5 percentage points every single year. That gap is not a rounding error. On a $50,000 portfolio over 20 years, the difference between 11.4% and 17.9% is over $1.1 million. That's the real cost of being an active day trader. Not the losing trades. Not the bad days. The slow, compounding drag of average underperformance. And this isn't one study. A 2020 paper from researchers at the Federal University of Brazil analyzed 1,551 day traders who persisted for at least 300 days. Only 3% were consistently profitable. Only 1.1% earned more than minimum wage from their trading activity. 1.1%. Then add the tax layer. Day traders pay short-term capital gains tax. In the U.S., that's taxed at your ordinary income rate, which can be as high as 37% federally. Index investors who hold for over a year pay long-term capital gains tax, maxing out at 20% for most people and 0% for lower income brackets. That tax difference alone can erase years of trading gains. And we haven't even talked about time. The average serious day trader spends 6 to 10 hours in front of screens daily. That is a full-time job with worse benefits and no employer match. Swing trading, the middle ground that isn't. Swing trading gets marketed as the smart alternative. Less frantic than day trading. More active than boring index funds. The best of both worlds. The reality is more complicated. The mechanics are straightforward. You're trying to capture price swings, buying when a stock looks like it's about to move up, selling when it looks like it's topping out, holding for days or weeks. The actual performance data on retail swing traders is harder to find than day trader data because most retail swing traders don't track their returns properly. But the research that exists tells a clear story. A 2004 analysis published in the Review of Financial Studies found that technical trading rules, the backbone of most swing trading strategies, generated no significant profits when transaction costs and taxes were accounted for. Here's why swing trading is harder than it looks. Markets are not predictably rhythmic. The patterns you see in hindsight are obvious. The patterns you need to see in real time are buried inside noise, news events, earnings surprises, and macroeconomic shifts that no chart can predict. Every swing trade you enter also has friction, the bid-ask spread, brokerage commissions, and the tax hit on each closed position. That friction compounds over dozens of trades per year. Now, swing trading isn't worthless. There are disciplined, skilled swing traders who outperform the market. They exist, but they represent a tiny fraction of people who attempt it, and becoming one of them requires thousands of hours of education, practice, and a painful tuition paid in real money losses. Most people who start swing trading stop within 18 months. Not because the strategy can't work, because the learning curve is steeper and longer than anyone tells you up front. If this math is hitting different right now, if you're realizing something about how you've been thinking about investing, hit the like button. It genuinely helps this video reach people who need to see these numbers before they make an expensive mistake. Index investing, the strategy that wins by not playing. Here is a fact that should make every trading course founder deeply uncomfortable. Warren Buffett, the most celebrated investor alive, has publicly and repeatedly said that the average person should put their money in a low-cost S&P 500 index fund and stop thinking about it. This is a man who has spent 70 years picking individual stocks for a living. And his advice to you is, don't do what I do. Why? Because the S&P 500 has returned an average of approximately 10.5% annually over the last 50 years, before inflation, around 7.5% after. That return requires 0 hours of screen time, no technical analysis, no earnings call research, no emotional discipline during market crashes, beyond simply not selling. Vanguard's own research showed that investors in actively managed funds underperformed their benchmark index by an average of 1.1% per year, just from fund fees alone. Not bad decisions, just fees. That 1.1% annually, compounded over 30 years, on a $100,000 portfolio, is the difference between $1.74 million and $2.16 million. $420,000 lost to fees. Not to risk, not to bad markets, to fees. Index investing wins for a simple reason. It doesn't try to beat the market. It IS the market. And over long time horizons, the market goes up. Not every year, not every decade, but with a consistency that no active strategy has matched at the retail level over 30-plus year periods. Here's what this math is really telling you. The financial entertainment industry, the trading courses, the Discord servers, the influencers flexing screenshots of winning trades, profits when you believe that skill and effort will be rewarded with market-beating returns. But the market is the most competitive arena on earth. Your counterparty on every trade is an algorithm, a hedge fund, or a professional trader with better data, faster execution, and more capital than you. That's not a reason to feel defeated. It's a reason to be strategic. The smartest thing most people can do isn't to find a better trading strategy. It's to stop competing in a game where the house has a structural advantage and start playing the game where time and compounding work for you automatically. So here's the practical breakdown. If you're starting from zero with under $50,000, index funds are almost certainly your best move. Open a tax-advantaged account. Buy a total market or S&P 500 index fund. Contribute consistently and leave it alone. If you want to swing trade, paper trade for at least 6 months first. Track every single entry and exit. Calculate your returns honestly against the index. If you can't beat it on paper, you won't beat it with real money. And if day trading genuinely fascinates you, treat it like a business, not a hobby. Cap your risk capital at money you can fully afford to lose. Because statistically, most of it will be. The math doesn't lie. It just takes courage to look at it clearly. Now that you understand how these 3 strategies actually compare, the next question is, how do you actually build a portfolio that grows, even when the market is crashing? That's exactly what the next video covers. It's already on your screen. And if this video changed how you think about trading, drop a comment below. Tell me which strategy you've been using and whether these numbers surprised you. I read every single one. See you in the next one.